Yeah, where you?
Cheese.
Hello, you recording? Yes, you are. Is he recording? Hello, hello, hello. Welcome to the call, the book review for Generation X.
Generation Y.
Generation Z, how's everyone doing?
As we secure the bag, we're on chapter 11, and we're 11. I do like that. So, are we gonna go from what did we do before? Who went first last time?
Y. I think it went X, Y, Z, Z, Y, X.
No, who turned it?
Do it.
LMNOP.
QRS.
QRX.
So, chapter 11, what investment account should you have? I know that Royal TV was saying this was a pretty good, easy chapter, self-explanatory chapter.
Yeah, it was pretty straightforward and everything. Like he wasn't really going around, like he wasn't going in circles or anything like a lot of authors would do. It was going straight forward to like 401k and what you can do and how you can put your money into your 401k all the way to doing your IRA and which one might be better for you. Like from what I read, I think an IRA might be a little bit better just because it's more lenient in how he explained it. It has more options.
And also the matching. I like the part, the apps that they say get Robinhood,
Yeah.
Stockpile, the apps that you should go ahead and get. However, I got a question since I'm Generation X, and I'm wondering because I know probably a lot of Generation Xers did not do what he said do in this chapter, in chapter 11. What type of investments account? Because it was not a conversation to have.
Right.
And people end up getting a 401k. And I wonder if the people who are going to end up listening to this video, are they going to be like, okay, is it too late for me to go ahead and invest? Am I a lost cause? And things like that. And in my opinion, I'm like, go ahead and do it. Something is better than nothing.
Well, I will say, I think that's why it's important for you as like a parent to have these type of conversations with your kids because I knew about all of these. I already, not all of them. I didn't know about the brokerage account or the set IRA account, but because my dad had conversations with us about investments and 401k, and although I didn't know what he was talking about, I was still like, hey, it was still something that you heard in the household and stuff like that. So I think it's important as a parent to have because they don't teach these things in school.
Right.
And so when you get a job, you don't know what a 401k is or what an IRA is. And the thing is about our generation, what are we? Generation Y, they have kind of the whole 401k thing is obsolete. They don't have those options for us as much. So the Roth IRA is a better investment for people that don't have those options. So, but those conversations need to be happening,
Right.
with your family.
And it's like speaking on like the Roth IRA, like how what she said that people that didn't catch on to the 401k into like the last minute,
Yeah.
the Roth IRA does have that you can catch up. So you can start invest. You can put in 1,000 more per month to catch up with everything.
And also the SEP IRA, a lot of people want to start their own LLC, their own businesses. This is another reason why to go ahead, and if you're self-employed, if you have an LLC, you have that you can contribute up to 25% of your income to a maximum of 56,000 a year in that area. So go ahead.
Let's say that would be good. Like around, I know he's mentioned some stuff about some tax breaks and everything, and I know how rich they rich. That's one of them things that they do. find out like different ways to put it in. I know they said that you can wait until April to actually put it in there. So I'm pretty sure some research you probably got to do if you do like have that LLC and everything to not be taxed for so much as well.
Right. You got to understand the game in order to win the game. Because if you don't know the rules of the game, how are you going to win the game?
How you gonna play the game?
How you even going to play the game? Right.
Right. I thought it was really good and important that, like, I didn't know that if you leave a job, you have to roll your 401k over into a traditional IRA.
Well, you should do it.
You should do that before you leave because you might forget about your 401k over at your old job and you spend, 30 years at the next job. So it's good to, like, know that information before you leave a job and go on to the next investment or the next job, business, or anything like that.
Dre Lavelle, you got some mail here from a job that you had in the summer that has money inside of a 401k.
Speaking of,
it's when you worked in the summer for the city. So it's the state.
Send it on over here. Well, send it on over.
You might as well let it sit there. So then you can go back to the city of Chicago and say, oh, let me get that money. I need that right now. So you do have, because he said you might forget about it.
Yeah, and that's exactly what happened because not even thinking about it. I guess that's the one thing about the 401k that's not with the other ones because he said you will kind of forget about it. It's money that come out of your account before you even like see it at all, and it's before your taxes hit too. So I guess they all got their own advantages and disadvantages, different penalties and things of that nature. How much you can put into them. So they just do seem like one of them chapters you probably just come back to and get some information on. The last 2 to 3 chapters been like that. But really the whole book, really. But the last 3 has been more in depth and more granular on exactly what you need to do with everything.
Especially on the brokerage account. What type of investments are you going to get on the brokerage account? How to put your long-term capital gains, looking at that information. And it's a whole different vocabulary.
Yeah.
That people need to learn.
Yeah.
That's not talked about.
Yep. Exactly.
Yeah,
I'm on page 122 and I don't know why. At the bottom I put wow and I don't know why. I put wow.
Account.
No, I mean like I'd say because like it's funded with the after tax dollars, and if you look at the traditional IRA, when you're trying to access your money, is taking the 10% each time, and this right here isn't doing that. It's
right.
There's no penalty if you're in a specific tax bracket.
Right, and also the age. You said age before 59.
10% penalty before the age of 59.
No, you said
look 59 and a half.
Before 59.
Yeah, this one don't got.
And the other ones do have you a 10% penalty before the age of 59 and a half.
Yeah, 401k.
401k, the Roth IRA, all of them do, except for brokerage, and I want to say the SEP IRA, right?
Right. So it's a lot of stuff in here.
Percentage on SEP.
And then going further, okay, what's a great start? Robinhood is a great start. Robinhood, you don't have to have all the money in order to invest when you're doing a brokerage account. You don't have to have all the money as well as stockpile, which is another just in case. I like the example that he has. I know I pushed the example.
It's $1,000 at the bottom on the last chapter. The last paragraph.
Yeah, you can do your percentage.
It's like if the stock,
fractions of stock.
Yeah, the fraction of a stock versus a whole stock, which is expensive for some people. They can't afford that.
Like start where you are and with what you have and let it grow over time.
Ooh.
What?
It's hot and we're touching.
Oh.
It's hot
down there.
Yeah.
It's hot. It's hot. It's what, 83 degrees?
Oh.
That's inside.
Inside the house.
It's 83. When you talking about outside it's like 90 something.
We gotta get some services.
Oh. Okay. We have 54 degrees.
I wish I was there.
No, you don't.
You're right.
In June?
I mean, compared to this?
54 in June.
54 in June. So, action items that I put on. Let me know if you all agree with this. I have action items.
Go ahead.
Items, open up a Robinhood and stockpile. Invest in the stocks you researched in the last chapter. That's my action item. So the different things that we researched, did you all have time to research those items? Probably not.
Talking about Robinhood?
Yeah, the stocks in chapter 10, I know we were supposed to research stocks that you all were going to look at. So invest.
Oh,
No, I did not.
yeah. We're still working on that right now. We're still working on that. We're researching a little bit.
I didn't research in like stocks that was in that chapter. I was like looking at
Get your own.
yeah, so it's like a website called tinychat.com that had like right now they're only worth $3.7 million, and through growth through time, because it's basically a social media platform. Through
Right.
time, if it's on the rise, if everything's done correctly, it could be a really good investment.
Tiny chat costs that money. You sure?
Mhm.
What's that?
3.7. It's like between 2.4 million and 3.7 million.
That's how much per stock?
No, that's how
Per
much
share?
no, that's how much it's worth right now. I'm not talking about.
Oh, not per share. I'm like, it can't be that much per share.
No, I'm talking about
Good job using your vocabulary.
how much it's
I
worth.
know what you're talking about now.
It's like the worth of their, because like if you look at things like McDonald's and all or Facebook, the worth of their company in total is all the way.
Okay, so how much it is per share?
I don't know.
What do you
He's
call
still
it?
researching.
Tiny what?
Tiny chat.
Is it traded on the is it being traded?
It should be.
I'm gonna see this. Stock.
Tiny chat.
Yeah, tiny chat stock.
Like, what is it though? Like, what kind of social media is it?
It's like a live broadcast social media. So other than like you know where you are right now, you're like looking at basically a lot of people. It's like interaction social media. It's very interaction based. Let me see.
I want to see tiny stock prices. Yahoo Finance. The stock prices. It's a tiny chat live video.
Yes, it's a live video technically.
That's the thing you're on a lot, right?
Yeah.
So like Facebook Live going to a whole new platform.
Right.
It's funny how like Facebook be having stuff and it goes to like a whole nother stuff.
It's like
Facebook started like doing pictures, then Instagram came out.
Yeah.
like here it is right here if y'all can see it. So it's like basically people are just on a camera and like they're literally talking, watching videos together, watching movies. People have debates and everything.
Are they looking at us right now?
No, they can't see you.
Oh, it's not okay.
It's like, what's going on right now, man?
They're staring at you.
Okay, I'll look at it and see. That's something I might look into and see how much it costs per share because I can't find it right now. Alrighty, so chapter 12. What should you invest in? So I guess people who are joining late in the game and have a low risk, a mutual fund might be something to go with, especially if they're late in age and they don't want to lose their money. At least with the and also with the stocks, you're looking at the stocks that can have the gains and you can lose, but a mutual fund, everything is in that same area of things.
So you got like a lower risk of it.
Right.
Like if something go down, something's more unlikely to go up as well.
Right.
Like something's gonna maintain some type of status quo.
And that's what he was saying. Diversification is the investment strategy. So a mutual fund, you might have more mutual funds versus individual stocks inside your portfolio. You might have an index fund inside your portfolio. So you say you most likely became familiar with mutual funds with your 401k at work. So you're looking at that. So, okay. And also mutual funds, where he said he don't like mutual funds, he didn't say don't do it. He said mutual funds only report their holdings quarterly. Whereas stocks, you seeing what's happening every day.
Every day, yeah.
So like you don't have that much.
You probably have a whole spike and go back down when you come back time you get to it.
Yeah. No.
There you go, up, down. You're like, oops. And also, he said one of the primary reasons he prefer investing in individual stocks. He also suggests that beginners do the same. Is I believe we will learn more and can change our investments better. So he's saying in the beginning, if you're going to play this game with securing the bag, he suggests you go ahead and invest in individual stocks instead of mutual funds.
Okay.
And that's even how it was like
On the 401k.
on a cash flow game.
Yeah.
Like even like the mutual funds, you was gonna get steady up, but the individual is more of a high risk, high reward thing.
Right.
So just depending on how conservative you want to do it and how confident you is in it.
That's why you used to always win, huh?
Yep. Busting them up a little bit, you know what I'm saying? Yeah.
And like he was saying like on page 29 that he says it's annoying for how they do this, like how they take their money from it, but it's smart. It's not really annoying. Like they only show you how much you will really be receiving, and they take the fee from you automatically. So like you're not seeing the fee being removed. So they get their fee, and you're not mad, and you're still getting your money because
That's with the mutual funds, right?
Yeah, for the mutual funds.
And then the mutual funds, they went into load and no load. Because remember, Royalty V, how you said you had to read this chapter 3 times?
Yeah, I have to read this a few times to get through to like start like understanding this. These things are kind of, it's like the jargon that if you don't know the jargon, then you're not gonna really understand it. You'll have to go through it and actually study this chapter.
So what did you understand about no load?
I underlined some stuff.
On 130. 130.
On 130, the main thing I was looking at on here was the stop loss order. I wasn't really looking at the
Yes, that's on the
loss
stock
order.
area. Yes.
Like that, like you can like put it to where if your stock goes below a certain percentage, it'll sell it. It'll get rid of it.
Right, and you can set that up when you have a stock. If you have stock, it says, and I have that underlined too. I don't know if you can see it. I got it. No, you can't see it. It says stop loss order is a type of order you place on a stock in your account that instructs the company to automatically sell your share if the stock declines to a certain price. So if you know once it gets okay, I'm not looking at this, but it's going down, sell it now.
Help me, save me.
Yeah.
It's kind of like what I do in Vegas.
loss
Like I come to a certain amount. You know, like if you gambling or something, like okay, like if I go below this amount, well, like
that's why he hands me the chips because I'm like, I'm not giving you no more money. You're done up to this certain amount, and then we're gonna move and we're gonna walk away, and we'll come back the next day.
She pocket all my chips.
Yeah,
I won. I'm like,
yeah.
I'm thinking I lost.
He'll hand me the chips, and I'll just pocket them. And at the end, once he's out of chips in his hand, I'm not going to hand him any more chips to go just to spend
until we go to the next table.
Until we go to the next table. So it's kind of like an account, savings account that you can't touch, right? But the stop loss sounds like when it gets low, it'll just sell all shares for you.
You're not right, so you're not in the part that you end up losing.
Okay. Got it.
Yeah, kind of like if you went to Walmart or something, you'd be like, I'm only spending $150. It'll stop you there. So
or you ain't got nothing in your account. You can't spend $150. Yep.
Then it gets to the point he said, but they also have a stop order if you have $100 share and if it goes down, okay, that is the stop loss. So if it goes to 85, you go ahead and sell it. Okay. Then we went to index funds. I skipped all of this because I was like, okay, I will come back to understand this later on. Did you understand inside of index role?
Yeah, it do get a little
specific.
Okay, so if you look at
TRNEO.
So when I got through it, if you look at
Royalty be teaching us now. Come on, Royalty.
If you look at mutual funds, and like you know how you have you have a manager, a mutual fund that's basically managing a lot of your stuff, and you're paying that manager's getting a huge chunk of the money. It's gonna add up after a while, right?
In the index funds?
No, in the mutual. No, not saying in the mutual they did that, but the index funds is a little bit more like it's a little bit active versus passive management kind of thing. That's what it says right here in the first part. So where did it say? Where's it at? I just had it right here. All right. So the manager isn't going in and buying and selling all your stocks. So it's a little bit better for you. It's a little bit lower cost that you're paying for those stocks is what I get out of this.
Okay. Yeah, I got to come back to that, the index fund. I was like, okay, I'm reading it, but I'm not understanding it.
Because it says like on the bottom chapter, it says active mutual fund managers are human. They get affected by greed and complacency, just like everybody else. So the index fund is a little bit better on you. That's how I'm looking at it.
Okay. All right. I didn't highlight anything with exchange traded funds. I didn't highlight anything with that. So we were reviewing the book. I didn't with the bonds.
I highlighted some ETF stuff too.
Okay, go ahead. You did highlight because I didn't highlight anything. Go ahead.
All right, so like the main thing I got out of the ETF was that when you're paying for your manager to go and do everything, you're paying a commission. So it's not just nonstop paying. So it also ends up being better for your pocket. Okay. So there's no ongoing management fees on this one.
Okay. Thank you.
You can still you can still do the whole stop in the name of love and do the stop order on this one. Just like how you can with the mutual. It is basically saying to be disciplined in the investment process. So what else did I underline?
There's no management fee on that one either.
Okay, so it's like saying right here, it'll be like when you trade, that's when they get a commission of like $4.94 per trade fee.
Okay.
Compared to them having an annual amount that they're charging you off back.
Okay. All right. The next one was bonds. And how I understand what bonds is, you have municipality bonds. It's usually going to fund a city or a municipality. Is to help with that. I just didn't see any type of reason to invest in, because people always say you're going to invest in stocks and bonds. And I know what I understand about bonds is when the stocks are not doing well, the bonds are. You want to end up working with the bonds, and it goes back and forth. As the market goes up, as the rates go up in the market, the price of the bonds go down. So when the market goes up, your bonds go down. That's when you purchase the bonds when it's low. But when it's time for you to sell it, is when the market is going down, your bonds are better. So and also a bond. How I understand with a bond has to mature. If you do not take the bonds, if you take the bonds out, you end up cashing the bonds in before the maturity of the bond, you end up losing money. So it has to go. If you got a 10-year bond, you have to let it go. And also the grandparents get their grandchildren.
Yeah.
Bonds.
Yeah.
That matures over time, right?
Right.
Yeah.
By the time you're 18.
Yeah, that's that money that you can't
You
touch.
bought a $10 bond. By the time you're 18, it's $100, right? Something like that.
Yeah, that's what it is, right? So you have that. So usually I see that was when grandparents end up getting it for their grandchildren, or uncle may end up getting it. What do you say?
So the parents don't spend it.
Right.
Like, I'm gonna just hold your money for you. I'm gonna just hold it for you.
Hey, shut up.
I think my thing, like the thing that caught my attention the most, and it's probably just me, because like looking at the word government, because like you know how government, like they do bonds too, so they're borrowing money too. But federal bonds are like it says right here their interest is taxable at a federal level only. So like they charge you, like after they pay you back, they still charge you money for them paying you back.
How does that work?
I'm like, so you bought money from me and you paying me back, but I still gotta pay you for paying me back. Okay.
Just a game type of thing.
That's
So
crazy.
now, asset allocation. So in here in the chapter in the asset allocation, they're talking to say, I don't want to put all my eggs in one basket. So they're breaking down what type of stocks, value, location, bonds, what to look at when we're looking at that, and just understanding where to put our money. And I like how it says on 142, the formula. There's a formula. It says, for example, if you're 30 years old, this formula suggests that you should have 70% of your assets. Was it in 70% of your assets in assets and equities? But then they got a second formula. What it says? 20 minus your age.
Yeah, they always have like all these little formulas and stuff on here.
Right.
That should give you a way to gauge a lot of stuff too.
And I'm sure we got some people
You just want stuff to like grow for a minute and you get it like later, and sometimes you want to kind of like short term and long term goals in a way.
right.
You got like different things that, guess different pros and cons to everything, I guess.
Right. And they say age is a factor. You have your different factors that you're looking at. You have age as a factor. What's your risk tolerance? And I believe there's a test that you can take that tells you what your risk tolerance is, and also what's your investment time frame, 10, 20, or 30-year goals. So you're looking at everything on how you should be allocating the money and stuff.
Okay.
So yeah, that's what I got to it. And I'm sure we have people in our family who, I know on this end there's somebody in the family who was a stockbroker that we can tap into to ask question. You all know him very well. Well, Dre Lavelle and Royal TV, you know him very well. Mr. Shearer, he was a stockbroker. So
Mr. Shearer.
so he's educated. I can take that he's educated in that area. He understands that. He does understand that pretty well. And when you're talking about that, because he did it for a while.
Oh, she just got it. Look like, hold on.
Okay, all right. Or, oh.
It did like this. Oh. So where are we at on time?
Oh, right now we are at 30 minutes.
Okay, so we can start wrapping it up. Next week we're on chapter 13, which is entrepreneurship, and I think this is going to be really fun.
And
Entrepreneurship and multiple streams.
Multiple streams of income. I think this is going, and it's pretty short. It's only for this to be really great. It's only 4 pages long.
I'm really gonna enjoy this one.
So what's the next chapter? The next chapter must go with it then, like these last.
We might as well, because it says it's how to make your first
1K on the side.
1K on the side. We
should just go ahead and read that one too.
Oh yeah, but both of these are like 5 pages. So yeah, both of these.
So chapter 13 and 14.
Okay, we're working on this one as we speak.
Yeah, you can see these chapters are like.
Right, even chapter 14 has a good, but that's first 1,000 and generate multiple streams are like quick.
Yeah,
this income is gonna take a while to get to.
You got
right.
You have to purchase. You have to understand
all the mortgage terms.
Yeah.
And
buy a house and you'll understand it.
You know what? What we should do for chapter 14, we should do that separately, and we should bring Deneva on.
Yes.
Yeah, that'd be good.
Oh, she's really good at educating on the simplest terms.
Yeah, so we
don't know anything about it.
So next week we'll then do we'll do chapter 13 and chapter 13. Oh, it's 13 and 13. You all see that? He messed up the chapter numbers.
Oh, I think it's the
Yeah.
chapter might be too long. Oh no.
No, look at it. It said 13. Did y'all see
Come
that?
out now.
Uh-oh, I see it.
You see it?
Yeah, he did.
Hey, yeah, you think he did that to see like
Who's gonna notice it?
Hey, but you don't see it.
Wait, but
So,
in
13-1
in-
and 13-2.
the
13,
thing, does it say?
13,
Oh, on this it says 13 and 13
You got
too.
the 13 on 13.
On the table of contents.
oh, does it? So maybe it's on purpose.
It's gotta be.
I mean, because like in here it goes
It's a
13.
big old. Well, I don't know.
Okay.
They probably just go together.
Yeah, they do go together for real.
So we
They're
doing
just different
13 and 13.
subjects.
And then when we do 14, we're gonna contact Deneva and ask her. Shoot, I should call her. See if she picks up. We're gonna call her out.
On surprise.
I could call on the phone and see if she probably not gonna answer the phone. But let's go ahead and see. We're gonna call her on live, you all. Calling Deneva Carter. She's
She's riding in her convertible.
right. She's a mortgage broker, and she so I'm gonna call her and see if she answers.
Put her on the spot.
Oh, put her on the spot, and she probably not gonna answer. But so we're gonna end up contacting Deneva.
Your call has been forwarded to an off.
So she didn't. So good. So.
Why she don't answer the phone? Because she knows somebody gonna put her on the spot.
So we're gonna ask her for not next week, but the following week, if she can come on. We'll end up setting the time up with her.
All right.
Okay, Key, you gonna stop recording?
Yes, everyone.
So you all ready? Wait, we gotta do this.
Gotta grab the books, hold the books up.
Yeah.
All right, everyone smile. Recording stop.